Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us in this week's edition of the Market Carver as we kick off May here in Indiana. Always a lovely time. We'll soon hear the sounds of race cars traveling around the IMS as we look towards another Indianapolis 500. It always just seems to come so fast every year, but we'll jump right into the investing side. We've got a few topics for you today, two along the long-term perspective, try to zoom out and take a look at where we are in the midst of long-term trends, and then Andrew will update you on what we've seen in terms of market breadth. So long-term perspective. I think this is a great chart here. It was shared by Jim Paulson. It's simply taking a look at the long-term growth rate of the S&P 500. So the S&P 500 is going to be that blue line, and then the red line is going to be that dotted trend line, which is a 7.8% growth rate for the S&P 500. Tack on a dividend yield, and that's where you get into that double-digit long-term historical return. This can be helpful to help complement or pair against valuation metrics, such as price to earnings ratio, whether you're looking forward or backwards, or any way you want to put those together. It's also helpful to look at it this way because those valuation metrics can change over time, and the companies we're looking at today can be of a different variety with different growth rates and different accounting than they are in the past. So I found this helpful, and hopefully you will too. Where we are right now, we have declined just a little bit for the S&P 500. But remain about 25% above that long-term trend. So we've had this enormous rally following the COVID era, but generally speaking, over the past 10 years or so, we have been above trend. And there's nothing that says we can't stay in a continued bull market and above trend for a long time. So the takeaway from this chart is not that the market has to come down to get to that long-term average. It's simply that we are 25%. Another takeaway. And as we go to the next chart, what we're going to show is the premium or discount to that long-term perspective. It can get a little bit difficult to interpret here, but you can see sometimes we're above zero, sometimes we're below zero. When it's above, that means we are above that trend line. And if you look all the way to the right, that's where you'll see that dotted line, which is about 25% as it were today. Now, one comparison that I would draw you to is that dot-com boom in the late 90s. And so it's really interesting to see how different this environment was. A lot of drawn parallels, and there are, but not necessarily with the extremeness that we saw in the late 90s. At that point in time, we got up to a 100% premium. We were 100% above where that long-term trend would be. So this era is nowhere in the same ballpark as that era. Yes, it's a concentrated market. Yes, it's led by a handful of stock names, but a vastly different period in time. Now, if we were to come back to trend, I'm not saying again that we are, there's no reason we couldn't stay in a bull market, but just for some context, that doesn't mean that it would take a 25% decline to get us to trend. Instead, that would be a more modest 15 to 17%. Or if we were to grind sideways, it might take 12, 18 months, and we would be within the vicinity of it. So that's just in terms of where we are relative to long-term trends. Looking at the more near term and how the internals of the market have fared. Andrew, you are up.
Thank you, Adam. So as we're staying on the topic of equity markets, Adam's done an excellent job of looking at the long-term picture of the broad trend. And we always want to keep that in mind, especially when we're starting to see volatility. Now we're going to zoom in, and we're actually going to zoom in all the way into not just what the indexes are doing, but a topic I often cover in the Market Carver, what the individual stocks are doing. So one of the questions that we often get asked are what are some of the tools or insights that we use to seek out when the market has finally made its final low? And while we never are trying to find the exact pinpoint closing value of that day, one of the tools that has worked well in the past is looking for what's called breadth thrusts. If you've watched the Market Carver enough, the word breadth is probably stands out a little bit, but it's simply a fancy way of looking at the level of participation of individual stocks in rising or falling markets. And so when we look at thrusts of breadth, it's looking at we see on single days or a grouping of days where we see a lot of buying activity. We see a lot of stocks going higher. We see a lot of volume in stocks that are moving higher. And we have many, many different ways to measure these types of thrusts. All these people trying to get right back in the stock market market. And that's the type of activity that often shifts and begins to show us that we have maybe seen a low in the market, and we're starting to then look at all these people coming back in and how that sentiment and that euphoria starts to drive stocks higher. And so one of those types of thrusts is the one I'm going to share with you today. And I look at a lot of these is looking specifically at the NASDAQ Composite. So we often talk about the Dow Jones, we talk about the S&P 500, and then of course there's the NASDAQ Composite, and that holds a lot of tech stocks, has some financials in there, but it's not necessarily just the mega cap names. And so what we're looking at here on this chart, and I know there's a lot of squiggly lines at the bottom, is simply the number of stocks that are in short-term up or down trends based off of the average price of the last 20 days. And what we're looking for is when we see a lot of stocks that are in short-term downtrends, less than 15% are still in short-term uptrends, and then all of a sudden it goes from 15 all the way up to 80. We see that a lot of stocks that were in these declining markets, and then all of a sudden they've spiked back up. All this buying activity sending them higher. And so when we see that, when we go from just 15% to 80, doesn't happen very often, and that's where those pretty green lines on that chart show typically happen after we've seen a durable low in the market. And so as of the end of last week, we're still in the 70s. We're still in the 70s today as the recording on Tuesday, but we're getting closer to that 80%. And so we're looking for when we see a lot of stocks in the NASDAQ, because that's where a lot of the leadership had come during the prior bull market, where we were seeing a lot of the tech names that were driving things higher. When we see the market begin to move back into those types of names, can give us that confidence from at least this angle that we're seeing a lot of stocks begin to participate on the rally of the index. So this is just one example. What I'll often show when discussing with the advisors is I'll take all these different gauges of these types of breadth thrusts, all the different angles, looking at volume and price and all the different things that I spend all day doing, and boil it down into a single chart. And that's what the next chart I'm going to show you is. And this looks at a composite of all these types of breadth thrusts. I look at over 12 of these across multiple different markets. And what we've found is when you start seeing a lot of those thrusts occur at the same time, when all the different data sets begin to line up and they all start to spike higher, that gives us even more confidence that we could start seeing the trend continue higher. Now, the last bear market that we had, and not to classify this one as such quite yet, but in 2022, when the market finally was starting to make its bottom, we were starting to see a lot of these breadth thrusts. Over 6, 7, 8, 9 of these thrusts were beginning to occur after the market had finally put in its low. The same type of thing happened in 2018. We saw 6, 7 of these breadth thrusts occur, same after 2020. And so when we see the market decline, and then following those periods, when we start to see the market recover, we want to see all this rushing into buy. All these stocks begin to really show bullish at price activity. And those types of thrusts and activity can really give us a positive view on the market and give us confidence that maybe this turn higher is durable and maybe has legs to continue on. And so right now we've had 3 of those thrusts, not nearly what we saw in 2022. They could still continue to develop, but it's something we're monitoring every day to really evaluate how much of this market is participating when we do see the index begin to rally.
All right. Thank you, Andrew. And thank you to all of you for giving us your time. If we can be of help, whether we're currently have the pleasure of working with you, or if you've just got some way that we think we may be able to work together, please don't hesitate to reach out 800-928-4001 or scan the QR code and do so electronically. Thanks and have a great weekend.